Today, we are fortunate to have with us Professor Dirk Willem de Velde. Perhaps Dirk does not require a lot of introduction to many people, but I will have the pleasure all the same to go to introduce him today for this presentation. And what he's presenting is also a joint paper with the two co-authors, and I also have the pleasure of introducing them. First of all, Dirk joined the Center for Global Finance and SOAS University of London this year as the professor of practice. And it's a great pleasure once again to welcome and congratulate him on this honor of being a part of the transformation at SOAS University of London. But as you know, he's the Principal Research Fellow and the Director of the International Economic Development at ODI London. And he directs the program on supporting investment and trade in Africa, CITA, and also supporting economic transformation, ASET, and is indeed a research leader in the FCDO ESRC Growth Research Program that concluded at the end of last month, and in which SOAS and many other universities here present were participants. He has contributed prolifically over the last years to finance development literature, contributing over 30 peer-reviewed articles, 40 book chapters, 20 books, and so forth. And of course, a lot of commentary on ongoing policy that we cannot do a head count of, too numerous to count, but also focused on contributing to policy dialogue in the mainstream media, BBC, The Economist, the Financial Times, and many other outlets. In addition to being able to talk to policymakers at the highest level of government and international organization, including the UK Parliament, international organization, including the UN. He holds a degree from the University of Groningen in Netherlands, and also a PhD in economics from Birkbeck, University of London. You are most welcome, Dirk. But before I ask you to start speaking, I'd like also to introduce your co-authors, Phyllis Papadavid, who is the head of research and advisory at Asian House, and spent some time back a stint at the ODI London, heading the key departments that contributes to policy, in addition to practitioner work as a banker. And the third co-author of this paper today is Sherillyn Raga, who is here. Good to see you, Sherillyn. And again, to introduce Sherillyn, she participated in a very lively debate, contributing her work on an interbank market together with Judith Tyson only a couple of months ago. So once again, she's here. She's the Senior Research Officer in ODI International Economic Development Group, specializing in microeconomics, macroeconomics, finance, and structural transformation. So that's why it's a great delight that we have the three, but represented by a main speaker today, who is Dirk, on a very interesting question that is taking new proportions given the recent trends in the global economy today. Foreign direct investment and human capital development in Africa. Dirk, you're most welcome to deliver your seminar today. Thank you very much.
Well, thank you very much, Professor Murinde, and it's my honor. Well, first of all, to have been appointed a professor of practice in the Center for Global Finance, and also to discuss the my presentation on a paper that I've been working on with, as you mentioned, Sherillyn, Raga, and Phyllis, Papadavid. Let me try and share the screen. Let's see. Window. There we go. And so I hope you can all see it. Before I just start and launch into the presentation, let me just sort of briefly say that I'm sort of delighted to contribute to the Center for Global Finance at SOAS, and sort of after I finished my PhD at the University of London almost now exactly 2 decades ago, I've been sort of contributing to a range of policy debates. And so I hope to sort of be able to contribute that also to SOAS during well, today's seminar, but also in the future. And sort of these debates include the debate on development finance institutions, such as IFC, CDC, etc. And we started looking at that about 2 decades ago, and now they've been much more sort of involved in much more central in the development debates. So expect to hear more on that from me. And secondly, which is something that is perhaps more recent, is debates around the continental free trade area, so the African continental free trade area, and we at ODI sort of running from ODI running a program called Supporting Investment and Trade in Africa, CITA, and that supports the negotiation and implementation of the continental free trade area, and that also includes attention to investment as an issue, and so we'll be happy to sort of contribute much more on that. For today, and that's a topic also that I initially worked on for my PhD, which is around the link between foreign direct investment and human capital in Africa, and here I think what's really important is to sort of make the link between, on the one hand, foreign direct investment, a financial sort of measure, and the real side of the economy, and that's where I spent sort of at ODI the last 2 decades thinking a lot about policy issues, and so I think I've got a lot to contribute there as well. So the background to this paper, really there are sort of 2 major development debates, and sort of really policy relevant debates. So one is around human capital development and economic growth, and of course we sort of think through economic growth and the terms of economic growth, and often say actually human capital development is central to this, and of course the 2 go hand in hand. And then from a policy perspective, and perhaps from a sort of also donors perspective who are supporting countries in development efforts, you then also always think, well, education is important, human capital is important for economic growth. Therefore, make sure that we train more, provide more training and more education, and then that will lead to more growth and transformation. And I suppose that is, if you target it really well, that is fine. But it doesn't mean that all education is always very helpful. And here I think an important debate is to also make sure that we work not only on the supply side of education, but also on the demand side. So think that through. That's one debate. The second debate that provides a background to this paper is around the impact of foreign direct investment, and working on this, you first had sort of the discussion around how foreign direct investment from the balance of payments perspective helps to plug a finance gap. And so it's a financial issue. So from the Latin American crisis, there was a lack of financial capital, and therefore aid, but also FDI can help to sort of plug that gap. And that debate over the last few decades has, of course, morphed into not thinking, well, only about there's a finance issue here, but it's also thinking about the real impacts of FDI through technology, through trade, through employment. And also that policy matters a lot. So it's not just that any FDI matters, but it's the policy and institutional context matters. And these two debates have provided the background for a paper on foreign direct investment and human capital for a project that was being led by the African Economic Research Consortium, AERC, funded by the Gates Foundation. And that project is still ongoing. It involves a range of framework papers and also a range of country studies. So we were asked to sort of write a framework paper. And this paper that is sort of in draft form has sort of 5 sections, and that's what I will be discussing now, plus some additional experiences that I think are relevant to the theme. So there's some introduction on FDI and human capital. We think it's important to think about the impact of FDI on human capital through a supply and demand framework. We then provide a range of empirical estimates, building on some previous work that we've done, but new empirical estimates, and so the co-author Sherillyn Raga is here as well, who did most of the empirical estimations. And then we supplement it with a range of sector experiences, sort of being well aware of some of the data limitations, but also sort of understanding that we need to dig a bit deeper into some of the experiences around FDI and human capital. And then we'll finish with some conclusions and implications for further work. In particular, this was meant to be a framework paper for further work at country level. So it's a more general sort of idea of what I think is really important to undertake at country level. Right, so let me first start with foreign direct investment and human capital in Africa. So here, I suppose there's quite a lot of literature, both at the micro and macro level, of the importance of human capital education for socio-economic development, more generally, but in Africa in particular, and that there is sort of a lack of sort of human capital compared to other regions, and so there's quite a lot that could be done. Now, then, going into human capital and FDI, there's a sizable literature around the way in which human capital, and maybe measured by the stock of education and training, attracts foreign direct investment, including in Africa. And so countries that have more skills, a higher stock of schooling, of education, attract more investment. But other factors, of course, matter a lot as well. Let's unpack that in a minute. So FDI is attracted by human capital, but FDI also has impact on the real economy, and it has static and dynamic effects on human capital. Both static in the sense that foreign firms provide perhaps more training to their workers than domestic firms, accounting for size and other attributes of firms. And they can also have dynamic effects like technology spillovers. So let's unpack these two issues a bit more. So attracting FDI, there are a range of factors that play a role. Market size, market growth is important. Good quality and appropriate infrastructure is important, but also skills here. And in Africa, of course, natural resources has also traditionally been important as well, as has been privatization efforts as well for the services sector. Now, that's not the whole story, as I will talk about later as well, but it's not just that general factors play a role or economic conditions play a role, it's also that policies and institutions play a role. And then also the extent to which countries are signing up to international obligations play a role, maybe not as big as much as market size and so on, but they may still sort of on the margin play a role. Home country policies also play a role, so like countries that push FDI into Africa can also do that in various ways. Either sort of China is doing that through the Belt and Road Initiative, but it's also, I mean, even the UK, for example, is also trying to push investment into poorer countries as well. So among this range of factors, human capital is one of the factors. Now then, in terms of channels of impact of FDI on development, and here one important message is to sort of say that it's beyond macro finances, but beyond balance of payments. Here the impact, and UNCTAD have done range of surveys in the 90s already, and of course more recently through successive world investment reports, and always taking into account the different type of impacts that FDI has, and that of course there may have been sort of first a notion that FDI in the 70s was bad, and then FDI in the 2000s, and the World Bank and so on would say all FDI is good. I think UNCTAD has consistently said FDI can be good or bad. Policy matters and the different channels through which it works. So employment, incomes, technology, fiscal revenues, and it depends a lot on the context that matters. And what I would say is really important, and done some quite a bit of work on this as well, is that productivity spillovers are really important. So if you want to have a long-lasting impact from investment, then it's important to make sure that there are spillovers, productivity spillovers, knowledge spillovers onto the local economy, i.e. by linking into. Yeah.
Dirk, are the slides moving? Your slides there?
They're moving for me. Are they not moving for you?
I can only see slide 1.
Aha.
So
very good. So I'm on. So do you want me to reload? Is anybody else having the same problems? Maybe it is because it's too big a size.
Athena, are you seeing which slide are you seeing, Athena?
We are still on the first slide. Yeah.
Okay. So I think if
the general issue.
Yeah. Okay. Okay.
It is okay now.
Now it's okay. Yeah.
Thank you. Yeah.
Thank you.
Okay. If you see this, okay. Many apologies. Thank you for reminding. So let me do it in this mode, so you will see it in a bit smaller. So the channels of impact of FDI on development I was talking about, and that spillovers are so important, and those spillovers are dependent on a range of factors, but it includes policy as well. So the second part of the paper is around a framework through which we look at the impact of inward foreign direct investment on human capital. So as measured by education, stock of education and training and schooling. And inward foreign direct investment can have sort of micro effects and macro effects. And the micro, so the left-hand side of the chart, it's around so it's the supply side and the demand side. On the supply side, a foreign firm can have impacts on, for example, schooling through voluntary investments or scholarships, so that they can help the supply of education there. They also often have links with tertiary education institutions. There's been a sort of a link that I described over the years between the Beers South African mining investment in Botswana and the Botswana Accountancy College. The clear linkages there. And the third area on the supply side is through vocational training in-house and other training programs. And there's quite a sizable literature on the impact of foreign ownership on training, and that foreign firms train their workers more than local firms do, controlling for size, export intensity, and other factors. And they probably need to do that because foreign firms are linked into value chains, often into the international, exposed to international competition, need to be at the forefront of technology as well. At the micro level, inward foreign direct investment can also lead to, has also impact on the demand side. So by introducing new technologies into the workplace, you require certain skills as well. So you introduce new machines, a new way of doing things, that requires skills. So there's already a demand side there as well. And then you've got these issues can be multiplied and happen at the macro level. So on the supply side, foreign direct investment can have major impacts through taxation, through the general impacts it may have on on the economy. That may then lead to more emphasis on and spending on education, So if so Nigeria were to be able to use their revenues from oil investment, they could use that for spending more on infrastructure and education, for example, in the same way Botswana have done. But there's a further element as well. There's on the demand side, which is around dynamic changes to education systems as well. So the incentives that an investment may have, it may structural transform an economy, which may then lead to incentives throughout the economy, which may then lead to an economy to provide more or pay more attention to education and skills. We then, so that's a conceptual framework. We then look at an empirical framework and think about how opening up to or attracting more investment could then lead to more human capital development in particularly Africa. And there's also literature on this that we're building on, literature by Grossman and Helpman, which is around even when you open up to international competition and more integration, then that may lead to uneven development. So there's of course the standard theory, the Hatch-Olin model, that says if you open up your economy to trade and investment, you have a one-off specialization effect, allocative efficiency effect. Your GDP will increase one-off. But there's also a dynamic allocative effect. So your impact can be permanent. It can raise your growth rate, and not only your level of income, your growth rate through increasing the stock, having access to stock of knowledge, for example, internationally through opening. So that's trade and investment is a source of technology flows. And there's a literature that associated with this that says that there could be uneven development. It might be that countries that open up to trade and investment that already are specialized in high skill activities benefit more than countries that are not so specialized in high skill activities, that are perhaps more specialized in low skill activities, and will then not be able to build on high skill activities. And then you can get an uneven development. And that's been put to test by Adrian Wood for trade, and myself and a co-author in 2000 on FDI. And here, what we then do is we look at the impact of FDI on human capital development, and it's a function of sort of income per capita. So the richer you are, the more attention you pay to human capital, and other effects as well. So quality, that affect the quality, education opportunities, and also crucially for us, impacts from FDI, and also FDI interacted with skills endowment. And that captures the idea that if you're already well off to start off with, if you already have a stock of knowledge, if you already have a stock of skills, you can specialize in those activities and you build more on that. And so we want to test whether FDI has a bigger impact on skills development in those countries that already have a reasonably big stock of skills to start off with. And that's the delta 2 parameter in the equation. Now, the dependent variable here is schooling, and so years of schooling. Sorry, that's the skills measure. The dependent variable is enrollment rates, and primary enrollment rates, secondary enrollment rates, and tertiary enrollment rates. And you could argue that the enrollment rates may not be a perfect measure for human capital, and you want some other learning outcomes. And there are some recent advances in this, particularly the World Bank, that have tried to measure human capital. But unfortunately, those measures aren't really available for the period that we're interested in from 1970 onwards, and also are not available for many African countries. But overall, what we try to do a bit of some correlations, and Sherillyn can add more over time during the presentation. But the correlations tend to be still quite good between sort of educational enrollment rates, particularly on the secondary and tertiary enrollment rates, and the learning outcomes. So we still use enrollment rates for practical reasons as well. But we've provided an additional reason why we think it might be a good way to look at that. So then we undertake these empirical estimates and have a panel of countries, and we have period from 1970 to 2015, for which we have data. We have 5-year periods, so we use annual data, but also for 5-year split over 5-year periods, and then look at the dependent variables, enrollment rates, primary, secondary, and tertiary. And then look at the explanatory variables, in particular here, the variable FDI and the variable FDI interacted with skills and endowments, so as measured by enrollment rates, and skills and endowments as measured at the beginning of the period, the 5-year period, whereas the enrollment rates is the average over the 5-year period. And then we use this, we do this for sort of a basic model, but we also do this for lagged one period, so where FDI is lagged, because to account for endogeneity issues, so that FDI now will lead to dynamic incentives and for skills development in the future. We use measures of FDI flows and FDI stocks as well, and undertake some sensitivity analyses. And what we find, and this is a summary table, and the bullets are summary points, is basically that the impact of FDI is positive and often significant, particularly at secondary and tertiary levels of education, and less so at primary education levels. So that's already the first indication that it basically it helps higher levels of skills, and the effects, of course, and they are independent from possible effects that FDI may have on skills development through income. So income is a separate explanatory variable. So if FDI were to affect growth, and growth has a positive and significant impact on skills development, then FDI may also have that independent effect, or that indirect effect as well, separate to the effects that we report in this table. What we also find is that the impacts of FDI are stronger the higher the level of initial skills endowments, and so that's the interaction term. So there are often positive and significant terms, and that basically tells us that that FDI may have a role to sort of exacerbate skills inequality both within and among countries. It's not necessarily a negative story as such, because there may still be a positive effect, but it's just that the positive effects are greater in situations of higher skills to start off with. The effects are perhaps less strong in Africa, so we do both for all low and middle income countries, and then for sub-Saharan African countries. The effects are less strong in Africa, where the interaction between FDI and initial skills endowments has become perhaps insignificant, especially after 2000. So we did the initial skills, and that updated our previous paper. But we say that the interaction term has become a bit less strong, and we try to explain that in a number of reasons. But one reason could potentially be the way in which the sector composition of FDI has moved, because if we're saying that this interaction term is positive and significant for the whole sample as a whole, but it may not be as strong as it is for the subsample of Africa, and we find that the sector distribution is more relevant for skills development in Asia, for example, more manufacturing and more high skilled services, FDI, and the FDI in African countries has become or has stayed very much more in the natural resources sector, where there are more spillovers for education, than perhaps the skills composition, the sector composition of FDI may be such that the impact on skills development has become less over time, and that may explain also the less strong interaction term between FDI and skills, as explained in the previous slide. So the broad implications here are that FDI enhances skills development, good, particularly at the top end, so the secondary and tertiary education, good. But without additional measures, FDI may exacerbate skills inequality within and between countries. And so this will provide some broad evidence to prepare better to attract FDI. It's important to attract FDI and attract the appropriate type of FDI that is relevant for skills development, and also important to ensure that there's positive synergies between FDI and education. And so we need to look in that in a bit more detail, and we do that in the paper. So we look a bit more at the interactions between FDI and skills development at the sector and country level. So let me spend a bit of time on that now as well. So we look at some 5 sector country case studies, and whilst the regressions were naturally crude, the data are at country level, they're national averages, and they don't allow us to look into sort of the details. We want to look at the details because we think that that's really important as well, and that practical policy issues are also very important in this debate. So we look at sectors, and we then argue that so following on from this from these sector case studies, that the sector of FDI matters for human capital development in Africa, that the home country may matter as well, so where the FDI comes from, that the host country issues also matter, so that the initial skills levels also matter, and that the policy context also matters. And so let me explain a little bit why that is important, and also making the link to this conceptual framework that we had in section 2 that I put up, the figure 1. And you may not have seen that because the screen was frozen. So let me put that up here. This was the framework of the impact of inward foreign direct investment. So we had the micro level, the macro level, the supply and demand side. And so we look at that through that lens also in the final column here. So one sector that we look at is Ethiopian garments, and so there you've got quite a number of workers in the sector, so sometimes firms have thousands of jobs, and the jobs would be even more so if oops, can you still see the slide?
Yes.
Yeah.
Yes,
okay. Yeah. Sorry. That if there are local suppliers to those firms would also create jobs, would even be bigger. But you've got some training is being provided by firms, particularly foreign firms in the case of Ethiopia. It's some modest training and over a couple of weeks, for example. But so far there have been few spillovers, but nonetheless, it is you would expect there to be some positive impacts on skills development here. Slightly different area is automobile sector, and here we look at Morocco and at South Africa. And I used to look in a bit more detail in the case of South Africa, where there's strong interactions between education systems and automobile sector, particularly in the province of Gauteng compared to Eastern Cape, and where South Africa moved from a protectionist automotive sector to an export of world-class sort of Mercedes-Benz cars. In the space of a decade or two, and now the same has also been happening to Morocco as well. And there are of course a range of factors play a role, but the interaction between the skill system and the investors are important. Of course, this accounts for a small amount of workers, and that point was also made by Danny Roderick only just 10 minutes ago on Twitter, when sort of David Pilling did a story on Moroccan automobile sector yesterday in the Financial Times. That is a positive story, but there are few workers, but it may have significant dynamic spillover effects, and may therefore sort of structurally transform the economy, which may then lead to positive effects on the skills and education system as well. Now, the Nigerian oil sector, we see very few effects on primary and secondary skills. So they're often with mining or oil, it's very capital intensive. Only a few skills, and often these are enclave investments with very few links into the local economy. So there are few spillovers. There may be some CSR effects of sort of voluntary training programs and so on, but there may not be that many positive effects. Similarly, in the Zambian mining and construction sector, so a lot of FDI has gone into in Zambia has gone into the mining and construction sector, low skill intensive in the case of construction. It's also sort of a Chinese investment. They've had very little spillover effects as well. So there are few effects and there in the dynamic sense. We also look at the digital economy, particularly in Kenya, and here the impacts are not only direct but also indirect. So they are direct on the number of, so there's quite a lot of skill centers that have started in Kenya, and that requires high skilled workers, and so there's a positive interaction there. Perhaps the links between the ICT sector and the rest of the economy, i.e. manufacturing and agriculture, could have been stronger. The input-output model outputs aren't that linkages aren't that huge, but it could be stronger. But there's still sort of a positive impact, particularly there's an impact of the ICT sector on productivity. So there's also there are positive effects here. Now it's important to sort of think through that what I'm arguing here is that policy matters. So policy matters because, for example, the Moroccan and South African cases, there was strong interaction between the automobile investors and the education systems. And if there isn't that interaction, there isn't that positive synergy. Initial skills also matter. And so we came across, for example, a firm and we interviewed, it was Hella Garments, interviewed it both in Sri Lanka headquarters. It has affiliates in Athi River, EPZ in Kenya, as well as in Hawassa Industrial Park in Ethiopia. And it was able to expand its operation much faster in Kenya compared to Ethiopia, because in Kenya the skills level was higher, so they were able to use the workers much better and much quicker to supply the retailers in US. And so there were in the space of half a year, 1 year, 2 years, there were about 10,000 jobs in Kenya, whereas there's only about 1,000 jobs in Ethiopia, and that's primarily because of the initial skills level. So you also have it at the micro level here, and sometimes home country also matter. China sometimes are less interested in development, but it's not overall. But in this case, in Zambia, they were less interested in developing the country as a whole. Now, I'm arguing that policy matters, and within this debate, and so we've moved from the regressions in the beginning of the paper and the conceptual issues at the beginning of the paper to the case studies, and now to this additional information, where I think, and I've been able to sort of go around quite a number of African countries, particularly around economic transformation issues, investment issues, and talk to various stakeholders of policy, and you just can see the different approaches to FDI and to investment. So let me juxtapose here what we had, sort of Mozambique, for example, where we talked to the Deputy Minister of Trade and Industry, where there was a very laid-back attitude towards big-scale investment over a number of years, maybe 2 decades. You had these large-scale investors in natural resources, and there was no attempt to link into those investments at all, and not to build manufacturing capabilities around these investments. there was no proactive policy, and there's been a literature included by Castelbranco and so on of how few linkages there were between FDI and the local economy. So you wouldn't expect to be much impact on human capital development either. Let me then juxtapose that with sort of some other approaches which are a much more active. So, for example, there was there's a picture from Arkeeb Okubai, who did his PhD at SOAS University, who was responsible for designing and implementing industrial policy, and who's been much more instrumental in sort of thinking through an active approach to investment, attracting the right type of investment, and building on this and thinking about how you can also try and create jobs on the back of those investments. And then there are other approaches, sort of Kenya, sort of then Trade and Industry Minister Adam Mohammed was also sort of thinking through industrial parks. It didn't go as fast as Ethiopia were building industrial parks, but Kenya has also been attracting garments investment. And then you've got Ghana, different approach, and Tanzania, which is now undergoing a big shift as well. So the approach they've had for a number of years was not very pro FDI, maybe on paper, but in practice, although they have attracted quite a lot of natural gas or natural resource FDI, the real manufacturing type of FDI that could be useful for job creation, for human capital investment, may not have been there. And perhaps there's now, with the then Minister of Finance, now Vice President Mapango, there may be a more positive effect or approach towards investment, and a more active approach, which we're looking for in this idea about synergies between FDI and education and skill systems. And that's where I think it's really important, if you track investment, do it in a way that you have a strategy where skills fit in the story. Skills can help you attract more investment, but also it makes you generate greater benefits to your local economy. So that brings me to sort of the conclusions of the talk. I don't know whether Sherillyn also wants to add more at this stage or later, and we can engage with you with on sort of a discussion on some of the issues. But what we've done is we've examined the links between FDI and human capital, and looked at the conceptual links, argued that it's important to look at the supply and the demand side, particularly the human capital side, so that if you want to grow faster, more training isn't always the answer necessarily. You need to also work with what is in demand from the private sector, and the incentives that investors have, in particular also foreign direct investors have. And we then looked at the impact of FDI on human capital, and argued that this impact varies by initial skill levels that the country has, by the sector of investment, sort of where the FDI is located, by other characteristics of the FDI, and that also the policy and institutional context matter as well. So there's a hugely rich policy agenda here, a practical agenda that I think is really important, that we need to dig into much deeper when we think about the importance of international investment flows and how that interacts with a country's experience in economic transformation. So there's two sort of areas for further work here, and one, of course, is that we could benefit from more and more careful empirical analysis and attention to data. So this is one attempt. There may be better estimates might become available if we look more careful at some more data sets over time, and more disaggregation, perhaps more different empirical specifications as well. And that's definitely a fruitful area to engage in. And I think that also the Center for Global Finance has been undertaking this work, and I think also under the DFID ESSC Growth Research Program, under the the leadership of Professor Murinde has also undertaken work on the impact of foreign direct investment. For example, that's been really helpful and important, and so more work in that area is would be really useful to have. And we've also argued that more country level analyses could be useful, and that could provide more details into the practical links between FDI and human capital. And it could ask a range of questions, including what are some of the contextual factors that matter here? So does the sector distribution matter? And we've argued for now that yes, it does matter. So that would mean that if that matters, is that the ability of your country to attract investment in particular sectors matters. The initial skill and technology intensity of the sector matters. Motives and strategies of the multinationals matter. So you need to understand the motives of multinationals as well. And so they may have motives to tap into value chains, or they may have motives to tap into local skills and knowledge. And you can build on this. So that's one. Secondly, characteristics of M&Es will matter as well, and to determine the extent to which FDI contributes to human capital development, and you could perhaps incentivize investors to do more training. That's and I think Colin is also online. But I think in the case of the Republic of Ireland, the IDA provided incentives for foreign firms to invest in skills development, and that has been successful. Also, Singapore did that as well, and so it shouldn't be open-ended necessarily, but really targeted incentives to provide skills development and open-ended incentives that are linked into an industrial strategy could be very useful here. The third area that we think is really important, and that this highlights, is the importance of the policy context for spillovers. And so that table that I showed around the different sectors, the really long-lasting and really important effect, the really dynamic effects will depend on spillovers. So an investor may come to your country, may use low labor cost, or may use natural resources for a period of time, and then may leave. If you haven't had spillovers, productivity spillovers, knowledge spillovers, you have a problem, because then your level of income will decline again if the investor leaves. So the important thing here is to have long-lasting spillovers, is to link into your investors, is to build up your local supply capabilities and your productivity of your local firms in the same way as Ireland and Singapore did. And I think in African countries we're way behind that to really sufficiently build up your local capabilities on the back of foreign investors, and that requires an active stance, including around linkage programs, including around skills development. And then, of course, the wider context matters here as well, and I think that sort of wider attention to structural transformation, economic transformation, will help both attracting investment and skills development as well, and that perhaps sometimes working on the demand side of an economy, i.e. making sure that investors can invest in your country, will then lead to more skills development as well. So there's a lot of work that can be done at country level. Let me stop here and stop sharing my screen. And sort of arguing this is, I think, a very rich area of work where much more analysis can be done both at an empirical level and at policy level work as well. And of course, I think I'm a strong believer of bringing these elements together. That has the biggest impact on policy. So you want robust estimates, empirical estimates. You want to have a body of evidence that says a number of things, but has a coherent message. And then you want to make sure that you also take into account the policy context and the policy debates that are taking place, and then together you can have also an impact on policy, and that's what I think is really important to pursue with this agenda. So thank you very much. Maybe I should hand over to Victor, Professor Murinde now, for the discussion. Thank you very much.
Thank you very much, Dirk, and just want to give you applause for this exciting, informative, and a well-structured paper and presentation. And having gone through the issues very profoundly, explaining the challenges both in terms of policy with FDI and also in terms of human capital, especially the creation of jobs, covering also the literature, sometimes the containing different points of view, and then invoking a tractable empirical framework, run a couple of regressions, and even went further to do some case studies. I find the case studies actually particularly interesting as you are able to cover the different subsectors from garments in Ethiopia, automobiles in Morocco, oil in Nigeria. There are different types of FDI that go in, and of course, different skills development that happen with the FDI. So this work is absolutely comprehensive and generates very interesting results in terms of how skills development becomes central to developing FDI. And as you hinted somewhere in your presentation, as thinking, look at your and looking back to the work that I've just completed with your colleague Judith Tyson, Stephen Griffith-Jones at Sussex, and also East of Somalia in Laval, where we are say, well, the angel is in the details. That it is when you disaggregate this FDI and look at various types of FDI, various sources of FDI, and then you have also disaggregate heterogeneous sectors that you actually get more contradictions in that way. And maybe your work, although generalized, it is able to actually break through in this way. FDI can have these desirable effects on skills development, and maybe in some cases this may not happen. So absolutely interesting piece of work. Thank you very much for sharing it with us. At this juncture, I would like to invite comments, questions, views, opinions from the floor. Okay, let me try to please just invoke. There is a button that says raise your hand. For example, at the moment now, it is me raising my hand. But of course, I've already made my comments. So I can see we have Oli, Kerry, and so I'll start with the Oli and then go to Kerry, and then we take up more hands. And after that, Juan. So in that order, Oli, Kerry, and then Juan. Oli.
Thank you, Victor, and thank you, Dirk, for the interesting presentation. I have a question of curiosity. If you found, or you can speculate about an inverse relations between FDI and investment in human capital.
Okay. Thanks, Oli, who is predicting or hypothesizing an inverse relationship. And do we want Dirk or Sherry? Do you want to respond to this?
Yeah, sure. I mean, thanks first of all, Victor, also for your comment as well, and about that the angel or the detail the detail that matters, and that there is not necessarily one homogeneous impact, and I think that is really important to realize. So that 20 years ago, so I started at ODI working on FDI in 2000. The predominant view by in the development circles often was that more FDI is good, and as I explained, was that wasn't shared by everyone, of course, at that time, and that had followed the literature in the 70s that FDI in poorer countries was inappropriate and used inappropriate technologies. And Sanjay Lal, for example, arguing also in the 70s that the impact was perhaps negative, and so there was this policy swing, and I think really important to sort of try to understand this better and to explore this. And so therefore the impacts depend on policy context, depends on host country measures, home country measures. They depend on sectors and a range of things. And so I think that begins to help us to understand these impacts, and they're quite really interesting as well to look at. Then the question that Orly then mentioned, so the inverse relationship is an important one, and is and I wouldn't exclude it. And I think there are lots of important synergies here, right? So that there are synergies, and that of course the literature around attracting investment, and John Dunning did a lot of work here in the 70s and 80s, I think, around sort of having sort of dividing it into natural source seeking investment, thinking about efficiency seeking investment, and strategic asset seeking investment, and particularly strategic asset seeking investors want to have access to strategic assets, and it could be a technology asset, it can be skills, and so we always explain the investment in Singapore, for example, sort of headquarter investment by the fact that they did have the latest techniques and the latest technologies there, and the latest skills there, and of course the more skills you have, the more likely you're to attract in investment. So I would also say that that's important. And also, I mean, we also surveyed that literature, Novak and others, and early 2000 there have been sort of these regressions as well that talk about those links. We posit the other way around, and also set it up in such a way with a lag that there should not be the endogeneity as well. So because of course if there are these both ways interactions, then you would have potential endogeneity concerns, which you then have to look at, and that was an issue before the Nobel Prize was awarded yesterday, and it's still the day before, and it's still an issue now, and I think that is definitely something we need to look into, and basically the way we've done it is basically sort of we use a lag of FDI, which then influences skills development in the future. So statistically, basically, it should work that way. Way around. We've argued conceptually that there is that link, and that if an investment transforms your economy, structurally transforms your economy, and that is more likely the higher the skills endowment there is, then it also has positive impacts on skills development in the future. So I definitely think that it works both ways, and that's why we have these case studies as well, to sort of understand the complexities amongst the relationship between investment and education systems, which I think is really important to understand. So good question.
Thanks, Dirk. And I'll come back to Ollie if we have time, but there are a number of hands up because I suppose Ollie reminds me of this literature, which is now a couple of years gone, about immeasurizing growth effects. There was this huge literature that was put in the 90s about immeasurizing growth effects, when you get actually the perverse results compared to what you expected to get. You know, for example, expect to get improvements in skills, and you get the opposite. And maybe the inverse relationship may not persist. Maybe as you test more, you get a kind of U-shaped or inverted U-shaped kind of relationship. But I'll go to this now. I have a number of hands waiting to come in. So I think second was Kerry, and then I'll go to Juan. Kerry.
Yeah, thanks very much, Dirk, for the presentation. Very interesting. I was interested in the Ethiopia example around the garments, and I suppose slightly surprised that we haven't seen more spillovers. It'd be good if you could just unpack that a little. I wondered whether one factor might be around the duration of time that an industry has been established in a country. And I noticed that if you look at the Bangladesh story, where you have Desh setting up in 1979, it's really not until a couple of decades later that you really see big exports of garments materializing in Bangladesh, and whether, you know, this kind of time lag is just a factor which we haven't seen enough time pass in Ethiopia yet with that industry established for the effects to be felt. But any further light you could cast on that would be great. Thanks.
Thank you, Kerry. So Sherillyn, Dirk, would you like to respond to this? And
yeah, sure. I mean, I'll, maybe I can go first. Sherillyn, if you want to respond, feel free to do so at any time. Just, I mean, your comment, Victor, on the inverse relationship or on the emerging growth issue is also important. So I had interpreted the question as inverse in terms of sort of from rather than from FDI to education to education to FDI, but if of course you're saying that inverse, it's rather than a positive effect, a negative effect. That of course. So we didn't necessarily find a hugely negative effect, but there may be specific cases there, Sherillyn, where you can you can play a role. You found some of these examples. The question that Kerry was raising is a really important one, and I think I'm extremely sort of favourable to that view, that it takes time. It takes time to build up linkages, and it takes time, and in particular case of garments in Ethiopia, because it's due to models that are being used. I think the model in Ethiopia is similar to in Kenya, and it's different to perhaps in some other selected Africa, maybe in some other countries in outside Africa, and that has lots of implications actually. So the model that Ethiopia and Kenya have is that you import your raw materials or your textiles from Asia, and then you process it, and then you export it to the US. That basically, so that about 70% of your value is imported, and about 30% of the value addition is then through labor and some other issues. And so there's a very small share of what you're actually exporting to the US on the AGOA, so on the trade preferences, is linked to production in the country, and that is because the suppliers of textiles are based in China and or Asia, and so if you are able to locate your suppliers more in Ethiopia, then you're able to capture a bigger share, and the spillovers will also be bigger, and that happens piece-wise. So we saw this in the Havas Industrial Park. There was a garments assembler, and there was also a textile provider, and you can have different things. So it's also in the case of Kenya, you need a button producer who provides buttons to a jeans assembler, for example. And it can be more general around these issues. And of course, the work that also we did with you, Kerry, around spillovers is exactly that issue, which is important to that it takes time to do. And in the case of Ireland and Singapore, it's taken time as well to increase the local share of use of inputs, and so in Kenya that's about 20% or so, and it has increased from 50%, so it's already increased. But in like in Singapore and in Ireland, it's much higher, or particularly in Ireland, it was much higher. And that's just for the garments sector. It's not easy to change that because, of course, these are value chains, and there are reasons why headquarters source from Ethiopia, source from Kenya to supply the US, and so it's not easy. So you need to break into that value chain model. And you need to be able to sort of have the capabilities in country. And so linkages programs working around the zones is exactly where I think support should be. And it takes, and I would say it takes 2 decades and in Ethiopia we've got only 5 years of experience of the zones, and so we need 15 more years of support, including by donors, but also the government itself, to really see the and to exploit opportunities in the spillovers. I think I would say so I agree, and that's one of the things that I've argued in a separate paper in a volume edited by Arcade Occupy around our industrial zones, which I can share as well. So that's basically that. I don't know, Sherillyn, whether you have anything you'd like to add now on this question or any of the other questions?
Yes, yeah, I can come in with other questions if more relevant. I think you've covered very well the answers to the questions so far.
Thank you both Dirk and Sherillyn. So next we go to Colin.
Thank you, Victor. I wanted just to raise a question on the 2 points you mentioned in your bullet points at the end: strategies of MSCs and skill composition of the workforce. By way of digression or context, I'm now living in Aberdeen, which describes itself as the oil centre of the UK. And I'm always surprised by the number of people who work in the oil sector in Africa and other countries. It applies to both offshore work, where you have skilled construction work, and onshore, where you have skilled management supervision roles. And there's a lot of people in this town who that's their livelihood. So my question is, what can a government do in terms of policy to accelerate the process of localization? Could they use permits, for example, limit the number of expatriates who come into work in the sector? Or could they have some sort of expat local ratios applied to countries? It just seems to me that maybe, I don't know anything more about the sector, but there doesn't seem to be a process of localization and skill transfer to the workforce in the sector itself. But maybe you have some experience from your case studies on this question. Can policy be used to increase the skill transfer to those who are already working with the companies?
Thanks, Colin. Yeah, thanks.
Yeah, and I think that's a very important debate, and so it's about local content, and it's about local content of skills, but it's also local content of supply. And I think so there are two extremes here, and I always say that governments need to be in the middle. So one extreme is that there is no localization policy whatsoever. You leave it up to the multinational strategies, and they come into your country. They use whatever is there, and may not, because of their global business models, may not have an incentive to use local resources that much, either skills or other supplies. The other extreme is to impose very stringent local content requirements, and say multinationals need to have spend an X amount, like 75% of spending on local supplies, and also you only get 5 permits for your operations, and not more. And so there's these two extremes, and I think neither extreme works particularly well, I think, for the country, because the incentives of the multinationals and the country are not necessarily aligned. So that's the first extreme. Doesn't really work. You need to more an active approach. That's what I'm arguing for. So you need to work with the companies. The other extreme also doesn't work, because the investor may not come to your country, or when it comes to your country, it's highly inefficient, because the local supplies might not be available. So the trick is to ensure that you think dynamically there, and you think about where is your country able to provide the skills and the and the local supplies, where do you think it has a competitive advantage, or perhaps a dynamic comparative advantage that perhaps in 5 to 10 years' time you may be able to supply, and then work with that sector and impose requirements there in that particular sector, in that subsector. So not across the board, but basically say, well, actually, we want to work with you. We want to sort of say, gradually, we want to give you incentives to sort of say, well, you've got these many foreign managers, and over time we want to work with more local managers and give incentives for training. And that is actually happening, for example, in some garments firms in Kenya. I've seen one firm where a donor, I think it was even the sort of the FCDO, the DFID, was supporting a company to provide incentives for local management to upgrade, and over time get there. Not immediately, because that is tricky, and the foreign company may not want to invest initially, but over time. And the other is basically that what I argued in the case of Mozambique was that there was no effort whatsoever to locate any manufacturing capabilities of tools or something. They got an aluminium smelter. They could build tools and then supply the foreign companies with tools or whatever it is. They could do things. Over time, they could sort of say, well, actually, why can't you use these supplies, local supplies, because we can provide them at a relatively competitive rate. Maybe not now, but in 5 years' time we can, and then provide those incentives, and that you then work with a company that you source more locally. So there are attempts there, and they can be sort of on the legal side, and then you get into the WTO debate. Are they WTO compliant? Are they TRIMs, trade-related investment measures they called, and there's that one debate. But I mean, in practice, you can just you can work around it. Even Ireland did that. I mean, when I interviewed somebody in Shannon, from the Shannon Development Corporation, about one of the first zones, export processing zones in the world, and he said, and I argued him about GATT rules, and he said, well, we circumvent them. We do. Multinationals can circumvent them. They do their ways of accounting anyway. So they're not the binding issues. The binding issues are really the local supply issues that are important. But the other debate that's there, and let me stop there and answer your question, is that there's also voluntary issues there. And I remember sort of an ex-colleague, Michael Warner, who worked with some with British Gas, and basically said, well, and that was 10 years ago, like in the coming 10, 20 years, there will be lots of these investment in gas and oil, maybe not, maybe less now because of the climate change debate. But it's not a matter of whether it will be investment, but how you invest, and also whether you have a sort of a license to operate locally, because there was lots of protest around your investment. If you don't benefit your local economy, there will be lots of protest around it. So you need to make sure that the local population remain happy. And so you work with your government to voluntarily think about local content, and that therefore you want to build local content. And so what you can do as a government, you can sort of begin to ask companies to report on local content, and then measure that. And that's, I think, is something that is happening now in different countries, whether it's, I think, Ghana, there are a couple of countries where it was being piloted, and also there were local content requirements that have worked in the case of Nigeria as well, which I seem I covered a couple of years ago. So that if you work from voluntary, and then maybe once it is up to scratch, you can do more regulation around it. So you work with the companies. So first would be, how much do you source locally? And that, I think, will be interesting to hear, both from a government's perspective, the population, but also consumers that buy those products in the US or elsewhere. They may want to know where the products being produced, and increasingly also how. So with COP debates on COP, the Conference of Parties in Climate, you also want to know whether it uses energy efficient techniques and so on. So increasingly, consumers want to be interested not only where it's being produced, also how it's being produced. So I think that debate on corporate social responsibility being morphed into sort of something where companies are just doing much more for the environment, for the local economy, is proceeding. So there are examples there, Colin.
Thank you.
Thank you both, Colin and Dirk. Very interesting discussions. policy possibilities that could be invoked. I go back to the floor. Juan, sorry, I think I had skipped you. Maybe I could bring you in now, Juan Zhou.
Thanks, Victor. I put my question and no comments for Dirk to reflect in the chat, but I would like to elaborate it a little bit more. I think, Dirk, thank you so much for this very informative talk. It's very inspiring, especially, have this kinds of very comprehensive data set and then to look at the overall FDI and its impact on the human capital development, especially I think here is the human stock and in those countries. So my question is a little bit more dynamic. We're talking about human mobility because, over the past decades, the globalization, the multinational firms really drive the movement of labor and also drive this kind of mobility either in one way or two way and across the world. So my question, or I would like to you to talk a little about if you have found certain kinds of evidence in terms of for the impact of human mobility in contributing either positively or negatively the human capital development in African countries, because we have seen in other countries the human mobility really contribute a lot to the innovation, to the economic productivity, so on and so forth. Thank you.
Thank you, Juan.
Yeah. I mean, I need to there draw on work that I've done quite some time ago. So I did an extensive literature review on links between globalization and education. And globalization then is trade, investment flows, and also people's flows. So human mobility. And so I'm of the view that looking at that evidence that overall human mobility is tends to be positive, but not always in all cases. But in the whole, it is sort of a net aggregate positive effects across. So there's been this polarized debate in human mobility. On the one hand, just saying, well, all human mobility is good, similar to trade and investment liberalization, and that basically using the economic models, then of course you would find huge positive effects. And the temporary migration as well, like Alan Winter's done some models on this 15 years ago, so you get it. And the other side of the debate was sort of the human capital, the brain drain effects, as it were, and I think neither is necessarily where we are in actual practice. So in actual practice, are we in between? Because the brain drain doesn't reflect all the effects that take place when somebody moves abroad. So if you move abroad, that gives more skill, that provides dynamic incentives into your workforce planning as well, into your education systems as well. And I think there have been papers there even in the early 2000s that already showed that that more migration leads you to increase skills development, because of course there's a payoff for migration, and therefore you get faster skills development. But also it didn't take into account all the linkages that then comes once you have a stock of workers abroad. They have lots of trade and investment linkages with your country. They ask for goods. They invest back into your country through FDI, but also remittances as well. And so that can have a positive spillover effect on human capital development as well. And if you take that overall into account, and usually it tends to be positive, but of course it depends on the individual cases, and perhaps you might find a brain drain effects. And in fact, in 2005, I was already arguing for skills partnerships that were receiving countries who receive nurses, for example, who benefit globally of global public goods from it, should invest in skills development in countries that provide those skills, because it has a global public good element to it. And I think that debate on skills partnerships has become more important over time as well. But my feeling is that and particularly for multinationals and skills mobility, that's particularly important. So that's why sort of if you get mode 4 discussions in GATS, General Agreement Trading Services negotiations, the mode 4 in the European Union, for example, has always been the most liberal, so that basically multinationals are able to transfer staff within countries very easily, or between countries very easily. Just if it's within multinationals, it's more difficult for independent employees and so on. But they tend to be quite open, and that's and multinationals have consistently pushed for open regulation. Now they hit a brick wall, of course, in some of the countries that are just against migration, and that is the case not just in the UK, but it's also in poorer countries often. I mean, I was in southern African countries; they were also sort of quite anti-immigration as well, and that didn't help them to attract investment and to sort of build up centers of excellence, like Singapore has done, for example. So if you want to build up a center of excellence, you want to be like Kenya wants to do now in terms of finance, you will need to be open to skills movement at the same time as attracting investment. You can't do it without. So I agree that there are positive synergies, but it isn't as easy as all human mobility always is beneficial. But I am very positive towards human mobility, and I have no sympathy for just migration caps that are very arbitrary, or economic needs test on migration, where the barriers can be technical barriers to trade almost, that where they're so difficult to come by, where the labor market tests are so difficult to have that almost all migration becomes really difficult. And so I would say an open migration stance is just as important as an open trade and investment stance.
Thank you, Dirk.
Thank you very much, Dirk, for those detailed comments, and also Juan for raising the dynamics in human capital movement. Next, I think we call upon Peter Rose, who is the former finance minister for Seychelles, and has a lot of observations to make on this. And then next, we shall go to Prof. Kakari next. Now, Peter.
Thank you, Mr. Chairman. First, before I ask Dirk for my question, from a policy making perspective, I would like to congratulate you to become a fellow of the Econometric Society. Congratulations to you, well deserved. We should give you a round of applause.
Thank you.
Do I hear it? Okay,
thank you.
That's great. Dirk, thank you so much for your presentation. I think it's a well-researched document. But from a policy perspective is that, especially being a small economy, small economies are exposed to a lot of variabilities. And especially if you are attracting a foreign direct investments from a multinational, they come in with the objectives of a bargaining power. Being small, they want to crush you to pieces. So in effect, they will promise you, oh, I will develop your human skills development. I'll promise you, I'll give you a bridge, roads, corporate social responsibility. They will promise you heaven and the stars. Does this happen? I don't think so. And of course, my questions to you, Dirk, at what point in time do you make a real assessment? Is this a venture between the foreign direct investment and the human capital development really working in tandem? It's not only after a certain amount of years that we wake up, we say, okay, did we benefit? Where did we benefit? Where did we lose? So these are the things that, and obviously from a former ex-policy makers, we are always at the losing end in Africa. Because why? At the end of the day, we lack this synchronization to speak with one voice. That's our problem. I think it's time to wake up. We should, when we face foreign direct investment, we speak with one same language. But I think at the end of the day, I would like to hear your point of view from that end. Thank you.
Thank you, Peter.
That's very helpful. Could I ask which small countries you had particularly in mind? I can provide a general answer, but also do you have a specific country in mind?
I wanted to test you, Dirk, but nevertheless, Professor Murinde knows very well Seychelles.
Seychelles.
Yeah? Thank you.
Very good. I haven't worked in Seychelles itself, so I don't know the economy that well. I've done quite a lot of work in Mauritius, and which is an example, I think, of how they're using investment to upgrade, and I think their economy. And it hasn't always been foreign investment; it's also been domestic investment. But I would say that the importance is indeed to have a strategy for your investment, and so I would say be open to investment, whether it's local or foreign. Make sure you've got an environment where investors have obligations, but also where there are and responsibilities. So that is across the board for everyone. You need to play by the rules, and then the question becomes: do you want to attract certain types of investment, and does it include in foreign investment? Because I would say you would want to stand up to local as well as foreign investment in the same way, and making sure that they obey by the rules. So that's the question is: do you want to attract more, and what can you do with investment once it's in the country? And I think the example of Mauritius is one where they had a vision of the country, of how you want to transform your economy over time, where in the space of decades, where it was quite clear that not everyone would benefit necessarily from it in the first instance, because if you go from one sector to another, then you need to, then certain workers drop out of one sector and need to move into another sector, or need to be compensated somehow. So you need to have that in mind when you implement that strategy. So they moved from a sugar plantation, or a sugar monocrop economy, to one where, in the 1780s, in the 80s and 90s, much more textiles and garment sector, to one where there's tourism and financial services, and so they knew quite well how to have a vision, and to, in that context, use your investment and the proceeds from that investment to upgrade and to think about and when there's changes in international policies, the MFA and the multi-fiber agreement, to make sure that your domestic producers are either upgraded to standards and therefore can keep supplying the market, or that the workers are going into are retrained and going into other sectors. So my point would be, just use the investment that you've got, and make sure that you don't rely on the fact that those investors will be there all the time, always, but use the fact that they do give you benefits, whether it's through a tax system or otherwise, and then use those proceeds and use the skills to then promote other sectors that are more beneficial to your country in the future as well. So I agree with your point of view that you need to stand up, but I would say that is a positive sense. So I would say it's not the screening sense. The screening sense should just be overall regulations for all investment. They need to comply with, as like any investor, but you want to be open. The question is, do you want to facilitate some investors more than otherwise would be the case? Would you want to spend resources on attracting investment? And is it well spent? So it is well spent if you are able to articulate a vision for your economy in which that investment works, in which certain investments come in and other investment may not have come in. That example of you build a zone, you got a garment assembler, you may want to have a textile producer in there as well that supplies that garment assembler. So you want to make sure that you attract that investor, and then there can be synergies within the zone. There can be larger spillover. So that's a sort of industrial policy, the targeted way of promoting investment and facilitation that fits in your overall industrial strategy. So you help the market along, and I don't say picking winners necessarily. I say create the conditions, the right conditions for winners to flourish, and that's also a language that I've learned from Sanjay Lal on investment. And I think so formulate a strategy, stand up in that sense in a positive way. And then it will work. And there are plenty of examples of small states where it works. So and small island states as well. So I mean, I've done a book on small states and services in the late 2000s, where I found examples of where St. Lucia wanted to become Barbados, where Barbados wanted to learn from Mauritius. Mauritius wanted to learn from Singapore, and Singapore wanted to learn from the Netherlands, as it were, of how you do your transformation. And there are sort of some small island states, and I don't know Seychelles at all, but some small island states that are not active, that are very passive in terms of their stance toward investment, and have a governance deficit, and other small states that have an active policy stance and are really directing the economy, which you need to do compared to a big state, a big country, where it's more continuous. You need to have more. You have more discrete choices in small states, so you need to be more actively engaged in that debate, and so that being a small state doesn't necessarily mean that you can't sort of work with investors. You may be at a natural disadvantage, and I was talking on that earlier this morning, that there's also literature that basically says, well, small states have a higher cost of doing business because of the small scale. The utilities costs are higher in smaller countries than they are in bigger countries, because you can't use the scale. Therefore, you are at a natural disadvantage to attract efficiency-seeking investment. So you've got a bit of a natural disadvantage, but you can make up for that through good governance in the targeted sense. So you can be more active towards your policy, and you can be more flexible. So there are the positive advantages of being a small state as well.
Thank you very much, Dirk. I think that's a very good interpretation of the issue. Taking advantage of that size of the country or the economy to try to make the best out of FDI. Now let me turn to Purva Kakare. Please go ahead. I hope I pronounced your name correctly.
Purva, it's fine.
Purva, okay. Excellent. Yeah.
Thanks a lot. Thanks, Doug. This is a very interesting conversation, and I think I'm also glad that you mentioned industrial policy, because my question is around that. I do agree that policy context matters a lot, and so my question is a bit: have you come across an example of a country that has tried to overcome challenges of having low capabilities by having an active industrial or whichever policy stance? And by that, I don't necessarily mean having very stringent local content policy requirements, because as you said, that can also be counterproductive, but managing to attract the right kind of FDI in a particular sector because of the policies that they have in place. Because otherwise the general message otherwise would seem, if you are better scaled and better prepared, you will have greater benefits. But then where does the policy side of it come in to change the balance a bit out of it to your advantage? Thanks.
Thank you very much. Interesting.
That's a great question, and I wish Justin Lin and Celestine Monga were in the room, as it were, and their book, Elusive Quest, and some other books, sort of provide the answers and actually would argue that. I mean, they go as far to say that initial conditions don't matter. So there's a debate on whether initial conditions matter or not, and I think we argue that it matters to some extent, but policy also matters, right? So, but they would argue, for example, China is a case in point, that the indicators on infrastructure in the late 70s in China was very low. So there was very low. The initial conditions were very low, low quality. And China then used special economic zones, which they learned from. So the president visited Singapore, and Singapore sort of say, well, this is how we did the Jurong Island and so on, and the special economic zone. And China then copied it in 1979, according to sort of Justin's story as well, then sort of began to attract investors, and then began to make linkages with the local economy through building infrastructure between the zones and the local economy, both skills, infrastructure, and that basically over time the infrastructure and skills indicators improved, so over time, and that basically, if you believe that story, that is basically that policy matters an awful lot. It is the key determining factor, because if you hadn't built those factors there, now of course you could argue that it's a big country, therefore the possibilities of linking into your local economy are much stronger, and so that is not the same as you could do in Seychelles, for example. But China would be one example there. That of a country that has overcome weak initial conditions and have become very strong. Now, the other examples that I've often cited in my papers and also in this talk already was sort of Ireland and Singapore. So that's basically 10 and 20, took them 10 and 20 years, proactive policies to build up local capabilities and skills on the basis of foreign investment. These were small countries that had lost their hinterland, at least in the case of Singapore, when they left sort of Malaysia, and Ireland sort of had sort of Europe, but basically they had to rely on foreign investment. They put a lot of emphasis on it. They subsidized investment to come into their country. They interestingly also called up all the sort of the Irish workers in other countries and said, well, we are going to attract foreign investors, US investors. Are you willing to come back to Ireland to work in those factories? So they actually did that matchmaking actively, proactively, and sort of that policy. So they overcame the lack of local capabilities, the backwardness to some extent, then to build on the investment. Now, that's not the case that all countries want to attract investment to the same extent and can do that to the same extent. But you have example, Costa Rica, Chile. Costa Rica also famously attracted an Intel plant. Of course, I think it's left now, but attracted an Intel plant, build up their skills around it as well. Chile in very different ways. Then there's a difference between Nigeria versus Botswana versus Indonesia. So Nigeria, where the foreign investment had a negative impact almost because of the Dutch disease, and also the corruption around it, sort of the resource curse plus Dutch disease may have led to a negative impact of FDI in Singapore, versus Botswana, where FDI was used to overcome the small size of the economy, to invest in infrastructure and education, but not necessarily diversify a lot, versus Indonesia, which used this investment initially to also attract more manufacturing investment and diversified and had a more in the Houseman product space type of thinking, a much more diversified product space, now building on investment. And then there are sort of the Asian examples, many South Asian examples, where sort of the countries used investment to promote skills and jobs. So I think there are plenty of examples where there have been an active policy towards planning in a market-friendly way. So not the old-style Latin American style of thinking. Sometimes that thinking is still there, is that basically say, well, we now want to plan our economy and we can do it behind tariff walls. And as if value chains don't matter, as if you can do everything now. And that's that I don't mean by planning. What I mean is planning in a market-friendly way, being actively participant in global value chains. And I think there are plenty of examples where initial conditions may not have been that weak, but where you have worked with your investors, as long as you've got an active approach, and that would be the case for all types of investment that you have. It's not just FDI; it's also portfolio investment you can make use of. It's also aid flows you can make use of, as long as you are targeted. You have targeted interventions, and you've got a clear industrial strategy in which you want to manage the donors and portfolio capital. Mauritius is also a story which has been able to manage its donors really well to use aid flows.
Thanks.
Yeah, excellent, and great details provided there, Dirk. Thanks very much. We're almost running out of time, but I don't know whether Sherillyn, you have any additional comments to make as we round up.
Yeah, so yes, very interesting discussion that, of course, like within the FDI education skills development in African context that has emerged in this conversation. So maybe just for me, maybe just a step back a bit on like on the paper, and maybe like moving forward as well from this finding. So just a step back, no, so on FDI and the link to skills and to human capital. So what our paper, and also like from the conceptual, also empirical, and the sectoral level, well, maybe more on the empirical in general. So FDI, what we find is that it increases enrollment rates. It increases human capital in the form of enrollment rates directly, but it exacerbates inequality. And of course, inequality, the gap within and among countries, will have scarring effects, long-term effects on productivity and on the direction of the type of growth you want to go into the future. So as much as we want to address the increase of enrollment rates or education in itself, we also want to prevent inequality, skills gap within the country. So this paper highlights that the importance of that. So on one hand, of course, FDI is not the evil here. It increases, well, it has the direct impact on income, and we know income increases capital development. But our question is, how inclusive is the income that's coming from FDI? And that's where all this discussion that Dirk has highlighted and our colleagues in this meeting is the importance to scrutinize the type of FDI, the inclusiveness, the labor intensiveness of this investment that can actually trigger the increase in capital development in Africa. So my next point is, of course, so how do we counteract this? And this is where the policy making. So you can counteract in terms of like we saw in the empirical evidence that it's at the tertiary and secondary that's the gap within this educational level where FDI is contributing to the inequality. So can the public can public spending augment this area? So first, by, for instance, more investment in education, secondary and tertiary, you counteract the effect of FDI in increasing the skills gap. But secondary, it also helps to attract FDI, which you would want as well to increase overall growth and income. And so you address the gap through public spending, for instance, and on the other hand, increasing the linkages between the gap in human capital and FDI, as Dirk has been talking about, like partnership with universities, job matching, like skills transfers, managerial skills transfer and training as well. But also like, so it has to do with like taking stock of what your initial level of skills are, and then also looking forward to where you want your labor force to go, and also like the human capital development that associated with it. Just like, for instance, Philippines and India, for instance, have benefited from like business process outsourcing from initial stock of capital of English-speaking population. But why has India gone up to the global value chain and higher level services? It's because also the government intervened to provide more training way earlier, for instance, than the Philippines, that enabled the labor force to actually go up to the higher level of services. So all this interaction, like you invest public government investment in education, augmented by linkages with FDI, job matching, and then complemented by forward-looking policies. That's how we increase the stock and also increase the quality of the stock of skills. Yeah, that's my key takeaway from all the conversation in the paper. Thank you.
Thanks so much, Sherillyn. You have summarized it very, very, very well, and also pushed the boundaries to get us thinking into what to do next. We are running out of time. The conversation is still interesting, but there is a hand up by George. George, I will limit you to only 1 minute, please, so
Okay.
you can give your intervention. Thank you, George.
Thank you very much, Victor, and thank you for Dirk for the wonderful presentation. I was trying to ponder around, like in Uganda, you find that the FDIs are closing down. So what would happen to the future of human capital development? So I would have thought that within this kind of model, you factor in the issue of shocks, like for example, the pandemics, which has actually made most of the FDIs closing down in Uganda. So what do you think about this?
Yeah, thanks, George. George is based at Makerere University and doing extensive surveys on the impact of COVID-19 on businesses and other aspects. So I think he's coming in from that angle, which is absolutely helpful. Thank you.
Yeah, I think it's a very important question, George, and I think so it's also important work that you're doing, and so we're also doing some work with IDRC around the impact of sort of COVID and policy responses as well. We don't know Uganda, we've got this work in Kenya and Tanzania ongoing, and I think you work with maybe with EPRC perhaps, but the it is important to think that through the shocks and investment, and then there's also general comments. So in terms of the shock, is that I'm also thinking in the case of Ethiopia, for example, at the moment, is that the combination of some conflicts and COVID may have an impact on investor behavior. You don't know at the moment. So we interviewed a couple of investors, and they basically said, we're not going to leave Ethiopia. We're going to stay there. Our headquarters is set in SOAS and so on. So they do that for a couple of years and want and do not move with every new policy announcement right away. But of course, accumulation of effects might become important at some point. So that basically and I don't know the specific circumstance in Uganda, but if there is the combination of several shocks, and if it's also on top of that comes COVID, and it makes that impossible, and then the investor leaves, that is a big problem because, of course, there are beach health effects, the fixed cost of an investor coming into the country. It is important to attract that investment. That takes time and effort. As Ethiopians show you, they put a lot of effort into going to China to attract that investment. You need to put parks in place, and then if an investor leaves, that's a big problem. So that makes it all the more important. The central message of the work on FDI and the local economy is basically to say the impacts of FDI are not necessarily beneficial across the board everywhere. It depends on what you do with it. And so if you have been able to use that FDI so far in Uganda to upgrade your local capabilities, and if those local suppliers have become exporters in their own rights, as they did in Ireland, as they did in Singapore, if they also did it in Uganda, if you build up your local linkages, then you have had long-lasting impact of that investor. First of all, you want to hope that the investor can stay, so try and facilitate that company to stay. But if that investor needs to leave, let's hope that what you have done so far has been able to link that investor into the local economy, that the local economy has benefited not only from supplying that multinational, but has upgraded their local capabilities, their production capabilities to just survive in a competitive way in the global market. And so that is a test then, is that basically if the investor leaves, that your local capabilities are so mature that they can continue to produce. That's the test, I think. That's when you have really benefited from your FDI, and not only the temporarily in terms of jobs in your open supply. So let's hope that's really important.
Thank you very much, Dirk and Sherillyn. We run out of time, and this discussion is so interesting that it could go on forever. There are very important aspects of FDI which tends to be ignored in the literature. I think you have managed to sum up the key aspects, of FDI, especially the key sectors, and with examples of case studies, and also interesting aspects of human capital, and basically, job creation, building up skills, and of course, one could even extend this, building up skills, as well as having technology, in the sense that human capital is working not only with skill development, but in a combination of capital embedded, that is technology embedded type of human capital. So this discussion is absolutely interesting. Thank you very much, Dirk, for sharing this work and for having the patience to actually go through all these issues, quoting your wide experiences, across African countries. That's very much enriching. And this conversation will continue next week when we have another presentation on remittances. Okay, so and this is now remittances, applying remittances to SMEs access to finance. And again, we shall be reflecting on a couple of countries in Africa, drawing in particular examples from Francophone Africa. And this is work that will be presented by a very brilliant upcoming young scholar. She's with the World Bank Center of Excellence in Abidjan. That will be next week. But for today, we want all to give you a hand of applause, very much so, for this excellent work, Dirk, and yes, indeed, with Sherry and other co-authors. Thank you very much, and thank you all participants for being generous with your discussion and questions and comments.